Welcome back. Today we're going over another microcap stock. So this means a stock with less than $200 million in market cap value. I think it's probably more than that at the moment and has some serious upside potential to be even higher. What we're going to do in this video is I'm going to go through kind of the company presentation, tell you a little bit about it, and then do a deep dive into the financials. So let's get started. So first of all, big thanks to Nick the Greek for recommending this. He said, also for Magic Formula, Semler looks interesting. This was 3 months ago, and just let me show you this. 3 months ago, if you would have invested, he commented this, I feel like it was around $20 a share. It was before this run up, and you'd be up 30%. So look at that. More reason to read the comments of the video and maybe comment yourself to help somebody else out. Okay, what we're gonna do though is, like I said, look at the company overview, then look at the financials. Okay, so let's do that. What I have here is the investor presentation from May 2023. And the big thing is, I just want to tell you what they do. So Semler has this product called QuantaFlo, and it's a medical device / software that's useful in diagnosing PAD. So I'm not a doctor, but my wife is, and we were talking about it. And basically the current test for PAD is to do this thing called, something like an ankle brachial index testing. And basically somebody has to put this blood pressure cuff on your ankle, your arm, and then have these ultrasound meters, So it's more complicated. It requires a trained vascular technician, and it's, just more expensive, more of a headache, right? This is a device that they have. It's this little finger oxygen monitor thing. I don't know if you've seen some people wear those that people put on their extremities, and they have this software that incorporates that and gives them some results. Okay, so that's the product. That's really their only product they have. I'll go back up here. They have this second one that's QuantaFlo HD for heart dysfunction, but their big money maker is the first one, okay, that they introduced in the market in 2011. Now, look, this one's just recently been introduced, but we're not going to count that. So now I want to show you the financials and show you why this is such an interesting company. So like always, I have all of the quarterly results going back, as far as I could get them. And this one goes back to 2013. Look at this revenue though. That's huge growth. Okay, so since 2013, so that's 10 years, you've gone up from $18 million a quarter. This is every quarter. And then previously you were at, let's just say, well, I don't have to look. Yeah, 800. So 18 million to 800. That means you went up 22 times in 10 years. That's awesome. So raise that to the 1/10. Revenue's growing at, compounded 36%. That's wild. Okay, so that's always a good sign, but you always want to ask, is it translating to profit? Because that's what really matters, right? So if I go to pre-tax income, you can see the growth is there. It's probably not as drastic. You grew from losing money to making money, but it's still pretty good. Okay, so the company really didn't start actually becoming profitable until 2017, and then now they're making, on a pre-tax income basis, $4 to $6 million per quarter. Just like I always do, quick rule of thumb check. Let's say that they made $5 million a quarter. That would be $20 million per year. I say a great way to estimate fair value. And I say estimate because I don't think that you should go by this. I don't think you should go buy a stock based on this, but I feel like it's a good filter to pass things through whenever you're first looking at a stock, So let's just say that they make $5 million a quarter times 4, so $20 million a year. Basically multiply that by 10, 200 million, ratio that to the market cap. So we'll do divided by 172 and then multiply by the current share price. And that kind of tells you that roughly they're worth $29 a share. This is very high level. This is, like I said, just a quick little check. Anyway, do I want to look at anything else in the income statement? No. Okay, I'm going to go to the cash flow statement. So the cash flow statement, I think, is great to look at because you're comparing, earnings on paper to, what's actually bringing cash in. And I trust cash flow more than I trust income, right? Because you can make the income whatever you want it to be on paper, but you're either bringing cash in or you're not bringing it in. Of course, you can still manipulate it, but you can't do it as much as like the income statement, right? Okay, so this is actually kind of concerning. I don't care about variation in cash flow. You're going to see that with almost every company. But these recent 2 quarters dropped off pretty significantly. So if you want to know what's going on with free cash flow, you really want to look 2 places, right? Your operating cash flow and then your CapEx. So which one of these is driving this drop off in cash flow? And I'll go to the operating cash flow first. And okay, it's this, right? Because you have about the same pattern, just shifted a little bit because you haven't subtracted CapEx yet. Now you want to dive into, okay, what is causing the lower operating cash flow? So you go down the list. So net income, that's been pretty stable. So it's not the income driving the cash flow. Let's see, depreciation, that's going to be pretty flat too. I mean, this is $100,000 of depreciation. That is great. That means that there's like no capital involved here. It's all I'm sure they have low CapEx too. Stock-based compensation, you want to look at this, make sure they're not going nuts with this thing. Not really. I mean, I know we had a spike this quarter, but it looks like they do that. They do their stock-based compensation once a year. See, every 4 quarters, 3 in between. Okay, so it's not that. Deferred tax, change in working capital. This is usually where it is. Yep, bingo. Okay, so working capital minus $5 million. So this is kind of strange. So you want to go through, is it inventory? Is it receivables? So we'll look at inventory first. It's not inventory. I mean, inventory has barely changed. Receivables. Yep. Minus $5 million in accounts receivable. So this is kind of weird. And to drill down on it further, I'm going to go pull up accounts receivable in the balance sheet. Okay, so accounts receivable had this huge jump from $4 million to $9 million. And accounts receivable usually means money that's due to be paid to them after they sell something. And you have to be very worried about accounts receivable having big spikes up, because what happens, let's say you're a big manufacturing company and you want to sell stuff to a bunch of stores, you can offer better payment terms and, boost your income in the short term. But what happens is that you have this huge jump in accounts receivable and the cash hasn't come in yet, because basically you let people buy your stuff without paying for it right away. Maybe you changed your payment terms from 60 to 120 or 180, something crazy, right? So anyway, that would be concerning. However, I'm going to show you why it's not as big a deal with them. So let me pull up their actual 10Q. So this is their 10Q, and I'm going to Control F, search receivable, and look for the section where people will describe every line item. They'll have a little paragraph about it. So I want to know what is in this accounts receivable. Okay. Notes receivable consists of the following: secured notes, $1 million, and then notes at $5 million. Okay, so basically what happened is that they entered an agreement. They would fund $5 million to this Monarch Medical Technology company, and they actually wound up pulling $4 million out of that in March, as of March 31st, 2023. And they're getting 10% per annum on that $5 million. Okay, so in a way, this is not like a product accounts receivable. I don't know why it's counted like that. To me, it should be an investment, right? They loaned money, they're getting 10% on it. That should be an investing cash flow, not operating cash flow. But that's just one of these things where you can't just go buy some cookie cutter formula for everything. Sometimes you have to dive into it, because I think that this would have been a red flag for a lot of people. Especially think about how it ties into cash flow. Let me go back and show you that cash flow. So I'm back at the cash flow statement. How does this change their cash flow if you account for that $5 million that's been drawn in? So there's some of the last 4 quarters. So the last 4 was $14 million of free cash flow, and if you add that 5 back in, now you're at 19, right? 14 plus 5 is 19, which is pretty in line with the pre-tax income. So see, that makes me feel better, all right? Okay, so before we go on to the valuation of these guys, I want to show you the balance sheet and not just the accounts receivable. We're going to look at their total assets growing. That's good, $70 million. But look at this. Of their total assets, a huge percentage are current assets, meaning assets that are due to become cash very soon. And actual cash is something like, what is this, $45 million of actual cash. So they have $70 million total assets, 45 of that is cash, okay? And then look at this. Remember, $45 million of cash, and then total liabilities, $9 million. And of that $9 million, none of it is debt. I'm sorry, a couple $100,000 is debt, but that's it. Okay, so if I was going to adjust the market cap for this cash minus debt, the way I do that is I say, okay, the market cap right now is 172 million. However, if you were going to buy it, you would get all the cash, obviously. So I subtract the 45 from that, and then if I add the debt back, which there was like no debt, but what I'm going to do to be extra safe is actually add all the liabilities, so plus 9. And what you can see is that my adjusted market cap is something like 136 million, okay? So I'm going to use that. I'm going to use the free cash flow that I adjusted up with the accounts receivable and do a DCF. Okay, so here's the discounted cash flow. So let's say they are bringing in $19 million of free cash flow. Discount rate, I use 15%, but you can use whatever. And then growth rate, let's do something small. You know, look, they were growing at 30, but I want to see what it looks like at a small growth rate. What you can see is that the terminal value is $158 million for these inputs. Remember though, I want to adjust this back up to account for all that cash and debt. So really just shorthand, you can add, it was 45 and 9, so you can add 36 to this. If that's confusing, let me know in the comments because I might explain all that more later. But basically, this becomes a market cap of 194 whenever you adjust for cash and debt. I'm sorry, adjust for cash and liabilities. So to keep it simple, all I'm saying is that the market cap should be about $194 million with these assumptions. Okay, so if I ratio that to the current share price, so divided by 172 times 25, I get $28 a share for fair value. And remember, my little shorthand method was 29. I think this is pretty conservative. So like to apply a margin of safety of like 0.8 or something. Let's see, 0.8. Now I'm saying 22 would be your buy price or my buy price, you know. So that's kind of where my head is with this stock. However, there is one kind of major red flag that I want to go over. The big red flag is something that came out in one of their press releases. They just addressed it here, but it was before that. Okay, yeah. Significant event. In 2023, the CMS issued the final 2024 rate announcements for payment changes to Medicare Advantage and Part D. Okay, whatever. The big thing is that the 2024 model does not include risk adjustment payments for PAD, which basically means that their QuantaFlow thing is not going to be covered by most Medicare and Medicaid. That's how I took it. It's probably way more nuanced than that, but the big thing is that they're going to get less of the help from the government. And, you know, that's one of the reasons why I've stayed away from a lot of medical companies, pharmaceutical companies. The government is such a wild card in all this, you know, like they can just choose, oh, you know what, we're not going to pay for that. And now all of a sudden, what happens to your profits, you know, that sort of thing. So this is concerning enough for me to stay away at the moment. Now, that doesn't mean that I forget about the stock. It means, you know, I'm watching it like a hawk and hoping it comes down and then trying to understand exactly what this means more as stuff comes out about it. But yeah, that's it. That's what I think about Semler. I hope you enjoyed the video. I hope you learned something. Please like, comment, subscribe, emphasize comment. That really helps. And I'll see you next time.